is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Dave Sanders, who is an angel investor and membership chair at Sac Angels, that's Sacramento Angels, a long-running angel group based in Sacramento, California that's been investing in high-potential early-stage startups since the late 1990s. Through Sac Angels, Dave helps source, evaluate, and co-invest in seed-stage companies, primarily in Northern California, but also beyond, with a strong focus on technology and innovation. The group doesn't just bring capital to the table, they bring mentorship, connections, and real management experience, working closely with founders as they navigate those messy early stages of growth. Dave, thank you for joining us.
You bet. Glad to be here.
So where are you calling from today?
From El Dorado Hills, California.
Well, great. Let's talk about your experience at Sac Angels. What is the mission and evolution of Sac Angels and its role in strengthening the Sacramento startup ecosystem?
Yeah, Sac Angels was founded about 26 years ago. We just celebrated our 25th anniversary about a year or two late, so that's why I'm guessing that's about when we started. We have a pretty active angel group of about 70 members. We do about 15 to 20 transactions a year. I'd say heavily focused on the western part of the US, even though we're open to opportunities all over the country. Mostly broad-based tech, probably 70, 80% in that category. I would say most of the companies coming to us are looking to raise anywhere from $750,000 to 2.5. We created a multi-class LLC a number of years ago. So what that allows us to do, Hal, is write one check, which keeps the cap table clean, but it also seems to motivate our members to write more checks. We're typical check size is anywhere from 100 to 250K. I think the largest I can remember is about 450. And we've done some follow-on. So I would say mostly seed stage investing, a little bit of Series A, a couple of SPVs, and that's pretty much it.
Great. So what are some of the key characteristics you're looking for in early stage founders when evaluating an angel investment for them?
Yeah, I think clearly their ability to articulate their message well. So we understand, as an angel group, we may not have domain expertise in every segment of the marketplace, right? So I think it's incumbent upon the founder, CEO, to be able to explain quickly what the opportunity is, the problem that they're solving. And ideally, they've had some form of track record of success in the past. Maybe it's not their first CEO type role or founding role. Those would be some of the things we look for. And, I'm trying to assess their ability to continue to raise capital because most of these companies will succeed or die based on getting access to follow-on capital. So I think those are some of the things we focus on.
And so what are some of the sector or technology themes that are currently most compelling to Sac Angel members?
Well, everything is, has a touch of AI in it, but, how do you migrate from, basic LLMs to solving a particular workflow issue in a targeted niche, something that can convince us that they can build a moat around it, and they have enough deep expertise that makes them stand out and unique. So they're leveraging AI in order to accelerate their growth into that market segment. So that would be one area. I think there's a lot of opportunity in health tech generally. We have an aging population. There was tremendous amount of dollars being spent, and we get to see lots of deals, solving medical and health related issues.
So how do you see regional angel groups compete and collaborate with the coastal venture groups on both the West and East Coast there?
I look at us as part of a triangle between Sacramento, San Jose, and San Francisco. So as far as I'm concerned, we love it when they lead and we follow. Many of our deals, we're not the lead, right? So we'll work with organizations like Berkeley SkyDeck. We also created a collaboration between about 14 angel groups called NSYNC Angels, and we love sharing deal flow. So it's not competitive for us, for the most part, I think one of the things that really helped us is in 2021 we did 19 transactions. That ranked us number one in the state of California, number three in the country. Since then, our ability to get access to deal flow has dramatically increased. So I think that's been a big play. And then personally, I connect quite a bit with other angel groups and VCs that, may be looking to close out around, and we're able to move quickly. So we do 7 formal dinners a year. About 100 companies compete for 2 slots, just to give you an idea. Usually at least one get funded if they get to that point. But I'd say a good 20% of the deals, we have to move more quickly. Some of the best deals don't seem to line up with our dinner schedule. So we've been able to write checks. We have a subset of our group that's willing to move quickly. And if there's a strong lead, we have access to a good data room. We can write a check in less than 30 days. I brought an AI company to the plate a couple of years ago. We wrote a check in 3 days. And then 6 months later, the company was doing a follow-on, and we wrote another check in 3 days. The first check was 125. The second one was about 250. So I think that differentiates us a little bit in terms of our ability to move quickly when we see a really good opportunity.
Well, you've seen quite a few successful portfolio companies come through based on your track record. What are some of the lessons learned from successful portfolios and what differentiated them early on?
I wish I could say we are omniscient and really know how to pick winners. I think, there's some basic blocking and tackling. I think the benefits of having an angel group that's been around as long as we have and the level of experience we have in our group, the basic things like you don't make the mistakes in a term sheet that you would when you're first getting started. So that would be something that I think we found helpful, from our leveraging our experience. And then really, I think hyper focused on the initial team. Have they worked together and what kind of track record they have? And once again, their ability to present, in my view, is a big deal. We've seen many good companies fall apart because they just can't raise follow-on capital.
So you see a lot of founders out pitching. What do you tell them to do before they go out to raise that first round? What mistakes do you see them try to avoid?
Well, the first thing I tell them is, why are you looking to raise venture dollars? You know, if you look at the entire ecosystem of venture, that still represents what, a couple of percent of the companies that get funded around the country. So my first question is, do you have a credit card? Do you have any friends and family that want to invest in your venture? Not every company should be looking towards venture as a source of funding. Now, when they get past that, I think our experience has been over the last several years, we're investing more and more later stage. Very few deals are pre-revenue today. So we're really encouraging companies to be lean and mean and legitimately show month over month traction and proof of market fit. I think if they can't do that today, they're going to struggle to raise capital.
Well, let's talk about the importance of syndication and co-investing in early stage deals. What do you see going on there and what can you do to foster that?
Well, I think we are fostering that, just once again based on the NSYNC Angels thing that we've created, our connections to some of the other more successful accelerator groups that we're familiar with. But I think when you get right down to it, it still comes down to relationships. Even though I'd like to say we automate the process of sharing deal flow, it makes a big difference when we personally know somebody in another angel group or show up at one of their dinners or vice versa, they come to one of ours and you build on that kind of a partnership. I think that's where you get a chance to see more quality deals.
Great. And then, so how does Sac Angels support companies beyond the capital? What do you guys offer?
Well, each of us spend an inordinate amount of time coaching and mentoring. Once again, they come, looking for money, but what they really need is, more times than not, access to gray hair, deeper expertise, the ability to open up doors. I spend too much of my time on the coaching and mentoring, but it's truly what I enjoy doing. So if I can use my Rolodex to make a strategic connection for them, it's fun for me and it's a difference maker for them.
Great. Well, here post COVID, what trends are you seeing in the angel investing market? What strategies are you adopting today?
I don't know that anything is fundamentally changed post COVID, other than once again, we're expecting companies to get further along on their own nickel before they come to us. Probably that more than anything else. You look back at what happened during COVID, and these are things you can't predict. But more important, that they know how to survive in challenging times. And there's going to be times where capital is scarce, and can they keep the business afloat and get through the tough times?
Are you seeing that the exits are taking longer or people are staying private much longer? What's your experience there for getting to the exit?
Yes, it's definitely taking longer. I'm also a GP in a micro fund. We invested in about 25 companies, and COVID was not our best friend, so we're finally at a point where we've got six left and they should be exiting in the next 18 to 24 months. But yeah, I mean, it does take longer to exit, although some of the AI-based companies, I'm hoping they can exit in 3 to 5 years, because if they don't, the odds of somebody in a garage overnight coming up with something similar is scary. So I think there's going to be an opportunity for people to go, okay, I can get a nice exit here if I can just get to 5 to 10 in revenue and get out before, the things I don't know come and bite me in the butt.
Well, in some circles, the secondary is the new exit opportunity. What's your take on secondaries for angel investments?
Well, if you're lucky enough to be in a company that legitimately can take advantage of a secondary, then, obviously it's a good solution for companies that are going to linger before they, either get acquired or do an IPO. So I think there's value, but, most of the companies we're investing in don't offer secondary opportunities.
Right. And so what's your advice for new or, starting angel investors, wanting to build their own portfolio? What do you tell them to do before they kick that off?
I would say join an angel group, where you can start to learn the things you don't know that, can make or break a deal. You'd like to eliminate the dumb mistakes early. I would put small amounts of money to work on more companies, because I think over time, having a portfolio big enough that, as much as we'd like to think we can pick the winners, I think portfolio investing makes a lot more sense. At least it's worked that way for me personally. There's just too many things when you're coming in as an early investor that you can't predict, things like COVID.
And so we always teach diversity and diversification to achieve a return. How many investments should an investor make before they can expect to get the benefits of that?
When I talk to new members that come on board, I tell them they should be expecting to make 15 to 20 investments over the next 4 to 5 years.
Oh, okay. And what kind of returns do you guys talk about in your circle there?
Well, that's always a great question. There's studies that have been done, that over a 20-year analysis, if you invest in, 15, 20 plus companies, and let's say you have consistent discipline, putting the same amount of money into each one, not trying to pick winners too early, I tell people that it's not unrealistic to look at IRRs of 20%.
Mhm. Well, that's pretty good. So, well, in the last minutes that we have here today, what else should we cover that we haven't?
No, I think like anything else, as a startup, no great company's ever been built with one person. Align yourself with people that complement your skill set. Do a good job of vetting them out. Partnerships can either be great or they can kill a company. But, today I think the expectation is you need to get further more quickly. And usually that requires more than just one person. But in the future, it might be one person and 10 agents that help you get there. So we'll have to see how that progresses over time.
Well, it sounds like you got a great group and you're doing great things there. Appreciate you taking time to share that with us today. How best for listeners to get back in touch with you?
Yeah, you can reach me at dave.sanders@sacangels.com.
Great. We'll put all your details in the show notes there. I want to thank you for joining us today and hope to have you back for a follow up soon.
You bet, Hal. Thanks for your time.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.